Welcome. This is a video describing the Akuna Market Maker simulator software. We'll be going over the major sections of the simulator and also doing a live demo of the simulator in motion today. The simulator also comes with the user's manual, which has a lot more detailed information, so please refer to that for the information on all of the specific Greeks and column headings. I won't go into all that detail in this video. So we will start talking about the main sections of the trading screen. In this case, the main area is right in the center here. This is our main options board where we have calls and puts listed from the 260 strike up to the 560 strike in this product. The future is found over here, and it's trading 369.21 in this moment, and so the 370 strike is the at the money. You can see we have our theoretical prices here for our calls. So the 370 call has a theoretical of 15.08. We also have a bid and an offer that are made symmetrically around this theoretical. So here we're willing to purchase 26 contracts for a price of 14.875 or 14 7/8 and sell 26 contracts at a price of 15 1/4. So you can see that these prices are in eighths, but if you go over to this button here, you're able to toggle them so that they go from eighths into penny increments. So in this case, we are in penny increments now. The white cells denote that we are part of that market. So we're on all these bids, except we are not on this 430 bid. And that is because at certain points of the simulation, we have another fictitious market participant that comes in and cuts the market so that people who are running the simulator can't simply sit and wait for things to get really good, because at some point in time, the second participant will trade those things for very little edge. So it's a measure that we put in place so that people can't simply wait and be non-competitive. So other than this main option screen, we've also got a bunch of listed combos. So we have some straddles, some strangles, some call spreads, put spreads, a call fly, a risk reversal, and a couple of covered calls. And again, there's a lot more information about this in the user's manual. So these are listed, and there will be bids and offers that pop in throughout the simulation. In this case, there is a bid here that is from the last simulation that is right at our theoretical. And we'll talk about and see more of these as we go into the simulation. But if the bid or the offer is above or equal to our theoretical, the price will light up red in this case, or blue if it is offered below. And so that's just to alert the user that perhaps this is a price that is tradable because it is over our theoretical price and it is bid. So underneath all of these combos that we have listed, we have this price and volatility graph, and we'll talk about that more when we go into the live simulation. So the way that the prices are derived are through a Black-Scholes model equation, and the way that the users can change the volatility that is used to calculate that is by moving these controls here. So we have tick boxes, so if you hit the green box, it will tick your at the money volatility up by 0.03 increments at a time, and that's configurable down below. Or the orange box will tick it down, and so you can move your volatilities up or down in that fashion. You can also move the skew by ticking the skew box several times, and that will move the price of the calls up and the puts down in this case. And finally, you can move the 10, 5, and 2 delta call areas by ticking these boxes up. And similarly, the 90, 95, and 98 delta calls, or out of the money puts, up or down in this fashion. And you can see the result of all these, not only in the option prices, but also over here in this curve. So this is a plot of our implied volatility. And so you can see here that the calls, the out of the money calls, are on the right in the black, and the out of the money puts are in orange. And so you can see as I've moved my skew in this example, the curve is slightly tweaked to a call skew in this case. The x-axis is in delta space, so we always know where we are in delta space. And then the y-axis is our volatility at that point in the curve. So that allows us to move all of our volatilities, which then change the prices of the curves, of the calls. On the left-hand side, we have all of our position Greeks. So our delta, our vega, our slope, and our P&L. So on the left-hand side, we have all of our position Greeks, so our delta, vega, slope, and P&L, as well as our theta and our cash gamma. So as we're doing trades in the simulator, we'll be able to monitor our overall position Greeks here. We'll also be able to see our line-by-line positions in this column here, in the T-pos column, and that'll aggregate our total net long or short call and put position on the same line. And we don't differentiate our long call from our long put, because to market makers, for most of the time, a call is a put and a put is a call. So the upper left-hand corner in this top cell will show you if the simulator is running. At this point in time, the update is off, and therefore there is no simulation running. The second cell will just show you the time, and the third cell is a counter that when in simulation mode, you will see the counter increment, and that'll tell you where you are in the simulator, as each one in the manual has a specific set of steps. To the right of that is our futures trading ladder. So during the simulation, once you're accumulating deltas, you're able to trade out of them simply by clicking on these buttons. So this will buy 5 futures, and you see here I've bought 5 futures in my overall position, and clicking on the -5 will sell out those 5 futures. As you can see, once I do trades, they go into my trade list, whether they're futures trades or option trades. So the 2 trades will go here into the trade list, and the option trades will also flow in here. So as you do trades, you'll be able to see exactly what trades you're doing in this list. Below it is the market trade ticker, and that will show you all trades done in the marketplace. So the user's trades, as well as the fictitious other market maker that is competing with the user and sometimes trading things inside of the user's offsets and keeping them on their toes. So all market trades will come into this market trade ticker as well. We also have the ability to change the days, the trading days. So in this point, at this juncture, we have 62.4, so we're 40% of the way through a trading day. The interest rate used, and this volatility will be the volatility that we've changed down here, and it's just reflected up top as well. So now I'll show you how to go in and start a simulation. The reset button will reset the sheet and clear out any trades from other simulations or that you've done in the past. The start live button will get the future moving in some sort of random pattern to begin the simulation. And again, the way that the future moves is described further in the manual. Finally, we'll pick a lesson from the manual, and you'll have the users type it in. In this case, it's Akuna 4421, which is the name of the lesson to run. I'm going to hit OK. And then a pop-up will give students or users a bit of a rule of thumb as to how how tight you want to be in markets, as well as some guidance on what Vega limits you should be by step 45, which is close to the end of the lesson. Once everyone hits OK, options orders will start flowing into the marketplace. So you can see here some reds lighting up, and as you can see there, that 39 bid was traded by the other market participant, and it shows up in your market trade ticker. So in this case, we might want to trade this 420 call, or we might want to adjust our volatility up by clicking the vol up button. Once we see that we can trade perhaps these two orders against one another at some point, they will either trade when one of them has moved and matched against our bid or offer, and those things will pair off instantly, or if there is another way to trade, that would be that you can click on a bid or an offer, and as you can see, when I clicked on the 440 calls, it bought them paying the 370 price that they were offered at. So those are the two ways that you can trade. As you see here in the futures price and volatility graph, we're keeping track of our implied volatility. In this case, I've moved vol up. And this is also keeping track of the futures price, which you see is now starting to take a bit of a downturn. So after doing a few trades, students will be more comfortable with handling their deltas and other Greeks, and hopefully moving their volatility in a way that they're able to balance the flow back and forth. Finally, there's a pause button. So if we need to pause and discuss exactly what's going on in the lesson, or to allow users to catch up or ask questions, you can hit the pause button. The simulator will pause where it is, and we can discuss. And then when we're ready to, we can hit the resume button and go back into simulation mode. You can see the final piece, which is the wholesale trading window, and I'll demonstrate that now. So clicking this wholesale trading tab will bring up a new window, which you can position wherever is most useful and out of the way. And what this is used for is to trade open outcry orders. So you're able to create your own combos or outrights simply by typing in the strikes. In this case, I'll type in the 370, 390 call spread. And you'll see once I populate that, the ratio, default ratio of 1 to -1 comes up, and the theoretical price also pops in so that we can make our markets around that. If there's an open outcry trade, in this case, let's say someone paid 7.25 for 100 of them. Therefore, the user would enter in they sold 100 at a price of 7.25, and they would hit the trade it button, and you'll see the position goes into your trade list. Your Greeks also change, so this is selling deltas, and it'll also go into your trade list there. The next thing you would want to do is buy futures to decrease your delta. And finally, you can clear the spread and get ready for the next one. Another way to enter a spread instead of typing it in is you can click on the theoreticals of up to 3 boxes, and it will auto-populate a spread. So in this case, it'll take the most common spread with 3 legs, which is the call fly, and it'll populate the theo for that, making it a little quicker to input trades. Finally, you can save spreads, and it will hold the last 7 spreads that the user saves. And so that just allows you to quickly click on a button and come back to that spread and populate it without having to re-enter it. So clicking on these various buttons will populate the spreads that you've already entered. You can see in cell A4, the incrementer is now on step 27, and this script has about 44 before it ends. And what happens is there's a 10-second warning that pops up in this area before the script ends, letting people know to quickly hedge all of your deltas before the end of the day. And then finally, a game over will signify the end of the simulation. One other thing to point out, when you're filled on your total size, so in this case, the 450 calls, we sold our total number that we were quoting for. And so the number will turn red and it will step back away from the market until you've hit the reset quote button. And that signifies that you're ready to replenish your quote at a better price. Finally, we're able to bring up a risk matrix so that people can see the impact that a price change in the future will have on your overall position. So in this case, 3% increase in price will result in a P&L of negative $1,600. And then you can also see your Greeks at the various parts of this risk matrix. If you need to end the lesson, you'd simply hit the end lesson button and it would end automatically. And then once you hit the reset button, you're reset again and you can run a new script or a new simulation. This concludes our first tutorial on the Akuna Market Maker software. Again, please refer to the user's manual for much more detailed information on the manual and the simulator.